Hello students, this is our second lecture for admission of partner. Today we are going to understand about the treatment of goodwill. In the first lecture we have understood about the introduction, about what is admission and different treatment we have to do with respect to different items. Today we are going to understand about the treatment of goodwill. But the most important thing we should understand before we start solving the question or understanding about the treatment, why this topic has actually come in the admission of partner. See, we all know that goodwill is an intangible asset, like any other intangible asset, patent, copyright, but we are not making treatment for those, we are only making treatment for goodwill. And the reason being AS 26, Accounting Standard 26. What Accounting Standard 26 basically deals with intangible assets, and goodwill is an intangible asset. What does Accounting Standard 26 tells about goodwill is that there are two types of goodwill. One is purchased goodwill, another is self-generated goodwill. Purchased goodwill, as per Accounting 26, purchased goodwill means that goodwill we have purchased. That means when we buy any business, we buy their goodwill also. Say for example, if Reliance buys some division of Tata, like their coffee division or their tea division, so they buy the goodwill of the firm or the company also. So when we buy goodwill from the market, that means in totality with the business, goodwill is not sold separately. That goodwill is known as purchased goodwill. But that goodwill which we have created on our own, we are running a business for a long period of time and we have created a name for ourselves in the market. So that goodwill is known as self-generated goodwill. Now as per AS 26, only purchased goodwill can be recorded in the books. That means you can write goodwill in the asset side of the balance sheet only when it is purchased goodwill as per AS 26. If it is self-generated, you cannot write in the books. As far as your 12th partnership topic is concerned, if nothing is mentioned, it is assumed that goodwill is self-generated. Goodwill is self-generated. That means you cannot write, you can't write goodwill in the books of a partnership firm, because it is assumed that it is self-generated goodwill. If in question goodwill is written in the books, that is in balance sheet, we have to write it off. We'll see the treatment of that. So while attempting the question of goodwill, we should always remember the provision of Accounting Standard 26 that only purchased goodwill can be recorded, no self-generated goodwill can be recorded in the books, and in partnership, your 12th topic, it is assumed, if nothing is mentioned, it is assumed to be a self-generated goodwill. Now let's see, if it is not recorded in the books, then what happens? See, all assets are recorded in the balance sheet. Land, building, plant, machinery, copyright, trademark, debtors, cash, and different liabilities are also recorded. Now when a new partner comes, what old partners do, existing partners? They see the balance sheet, they calculate the total assets, total liability, the net value of the business, and they ask the new partner to pay an amount to become a partner, and that amount is known as capital. So this capital which the new partner brings into the firm is based on the net assets, that is the value of asset and liability in the business. Now as I told you, goodwill is not recorded in the books of partnership firm as per AS 26. So while calculating the share of capital the new partner will bring, goodwill is not taken into consideration. So that will be a loss to the existing partner, because the new partner will become partner only by giving that amount which is written in the books. What is there? Goodwill is there. They have created a goodwill, the old partner, but it is thus that it is not recorded in the books. So for that, they will make a separate treatment for goodwill. And this is what we are going to learn in this chapter.